Yeah, let's take a look at the assignment for round 3C. So I said in the first question, I said provide at least 3 methods a team might employ to increase its leverage ratio. And why would I say increase your leverage ratio? And I'll just add, I've kind of been picking on that a little bit, that I know in fact, I penalize you if your leverage ratio gets too high because there is risk in that. But I would be remiss in saying that in a game like this, leverage is a tool. Okay, and I say that especially in a game like this because we have rapidly growing industries here, round 5 notwithstanding, but we have rapidly growing industries here, and if I can borrow money at a certain rate and get a return that exceeds that rate, I would want to do that all day long. Okay, and the other thing to remember is that those rates of returns are compounded, whereas an interest rate that you're paying is not. And so it can be, even if you're borrowing money and in the first year just getting a rate that's commensurate with your borrowing rate, in subsequent years as that compounds, it becomes a wonderful thing. Okay, and so while leverage is risky, there's absolutely no question about that. It can also be a very meaningful way to improve performance in terms of especially ROE and perhaps earnings per share. So what are some methods? And I've thought of 3. There might be others that you guys will come up with, and I'll have to kind of analyze it. But I put these things in here. First, leverage is equal to assets divided by equity, and then I also put the accounting equation, which is that assets are equal to liabilities plus owner's equity. Okay, and I did that so that we can kind of take a look at what's going to happen, with the equations as we do this. So I said I said a stock buyback. Okay, so what happens at the stock buyback? Well, we reduce our cash, which reduces our assets, and we reduce our equity because we're buying back, we're retiring stock, we're putting it on the shelf is technically what we're doing. Okay, so these two go down, but liabilities stays the same. So assets have gone down and liabilities have stayed the same. Okay, and equity's gone down. I guess when I look at this, assets over equity. So assets go down and equity goes down, and they go down by equal amounts. But if you go down by equal amounts, it's going to increase the ratio, right? If we start with $100 say in assets, I'll just kind of put this in here, and $50 in equity, we've got a ratio of 2 to 1, right? But if we buy back stock, let's say we spend $20, right? So then we have $80. I'll go back here. $80 of assets and 30 of equity. Okay, now what's my ratio? Well, it's 2 point something. Okay, 2 point something, 2.333 is what it would be, and so it would increase that ratio. Okay, a dividend payout. Okay, a dividend payout has no effect on. Well, let's take that back. Does it affect owner's equity? Yes, it does. Okay, and it, like a stock buyback, is very much the same. Okay, in fact, it's identical in terms of how it's going to affect this leverage ratio, because we're going to reduce assets because it's going to take cash, right? And we're going to reduce owner's equity by a commensurate amount. So it'd be exactly the same, that ratio thing with as the stock buyback. So then third one I have is borrow money to purchase assets. So in this case, we're going to increase our assets, we're going to increase our liabilities, but our owner's equity is going to stay the same, right? Because borrowing money and which is increasing in assets, those two elements, they increase by the same amount. So again, let's go back to that same. If we have $100 in assets and we have $50 in equity, but we borrow money, okay, what happens? So if I borrow money, my assets might go up by 20, let's say, right? Okay. My liabilities would have been 50 as well, right? If I had let's go back to that, because if I had $100 in assets and $50 in equity, I'd also have to have $50 in liabilities. Maybe I should put all three of these up here, right? Oops. So I've got $100 is equal to, 50 plus 50. Okay, but if I borrow money, okay, this could go up to 20, then I might borrow something that's, let's go back, because my ratio then is 2 to 1, right? But then this goes up to 20. Say I borrow something or buy assets that are worth 20, and this goes up to 70. Oops. Okay. There we go. Okay. But now what's my ratio here? Now I've got 120 in assets and 50 in equity, and so again, then it's 2.4. So I've increased my leverage ratio. Okay. Maybe to a point that's not good. I don't know. Again, it would depend on the game, what the round of the game is, and all those other things. So, okay, and there might be some other answers here. Those are the three that I thought up off the top of my head. So, 2, assume Andrews paid a $5 dividend per share last round, the third round. What impact would that have had on, and if applicable, show the actual number. So on ROE, it would have increased ROE. Okay, so a $5 dividend, and that's $5 based on the number of shares outstanding. Okay, and I could have kind of rounded this, but the number of shares outstanding, so I'm looking at Andrews. Okay, so 2.399, right? So it's going to be just about 12 million, but I did the actual math, so it's just a little less than 12 million. So that reduces the equity by that amount, right? Okay, so our beginning equity was, and by beginning I mean the equity really at the end of the year, but beginning in terms of my equation here. I'm going to go up here. Oops, my equity is going to be down here. I'm sorry. I'm going to take a look. Total equity 103,314, right? And then I subtract the approximately 12 million, right? So I end up with about 91 million in adjusted equity. My net income was 25 million, okay? And so I divide that then by my new equity, the 91 that I've done, and my ROE would go to 27.54 as opposed to the, scroll back up, I think it was about 25% or something that they had, 24.3. So I could have increased my ROE by about 3% by paying a good dividend. Okay, earnings per share, there's no effect. All right, paying a dividend doesn't affect earnings per share because dividends are paid after earnings. Okay, so earnings per share is just earnings divided by the number of shares outstanding, and so it doesn't affect the number of shares, nor does it affect the earnings because dividends are paid out after earnings, so there is no effect on that. 3, in the real world, what does PE stand for? What is the PE for Amazon? PE stands for price to earnings ratio, and it's simply that, a ratio of the price of the stock, and I should have had this looked up here, but simply the ratio of the price of the stock, okay, to the current price. And so the answer that I get today would probably be a little bit different than what I got when I filled this out because it's changed, right? And you guys know I kind of like Morningstar. Hopefully you remember that from finance class. It's a pretty good site. Okay. So it's price to earnings. So if we take a look and kind of break it down, it actually gives it to us. But current price, right? Last price $791.50. Okay, and then it's earnings, and I don't know if it gives us its earnings per share. We can come down here and get earnings per share, but most recent we're at 52 cents, 59 $1.25 for last year. Okay, so wow, I mean my price to earnings ratio then is pretty big. This one here is the forward PE, and you'll see I've probably given both. Yeah, 61.1. So what's the forward PE, and why is that different from, now it says a 61.5? What that's doing is looking at projected earnings. Okay, the current, and I got a trailing 12-month price to earnings right here. The trailing the TTM stands for trailing 12 months, was $179.06. That's more like, that's not a dollar figure, I'm sorry, 179.6. That's more consistent with what I was saying. If we looked at the income for last year as $1.25 per share, divide that into 791, it's going to be even more than that. So they're probably taking this quarterly and they're annualizing that to about $2. Okay, and that's where they're getting this particular 179.6 price to earnings ratio. So either one would be, relatively correct. And again, it's changed. The stock been up just a bunch in the last 2 days, and so it's really changed the values. Okay, what's the difference between market cap and book value? What's the book value of Amazon? It's market cap's total shares outstanding times the current share price. So again, we got the current share price is $792, something like that. Shares outstanding. It doesn't show, diluted average shares. So 485 million, that would be 485 million shares outstanding. And I take that times this price, and I would actually come up with a market cap then that's equal to about $375 billion. Again, that changes on a daily basis, changes on an hourly basis, really based on this price, right? Because this is changing, anytime during the course of a normal day. So that's market cap. Book value is the accounting value of assets, liabilities, and equity, often expressed on a per share basis, but we can express it in a couple different ways. So let's take a look then at financials here. When I'm looking for book value and the accounting value, I got to look for the balance sheet. All I'm really looking for there is owner's equity. Okay, so the owner's equity is always at the bottom. When we look at balance sheets that are set up like this, they have assets on top, liabilities and equity on the bottom. Okay, and so I'm going this way, and I have total owner's equity is this line here. It's not that bottom line because that's liabilities and equity. So it's total owner's equity is $13,384,000. Isn't that amazing that the market cap is $375 billion? That's what investors think it's worth, but its total actual book value. It's one of the reasons I picked Amazon. I kind of figured that there would be a huge discrepancy between these. Total book value is only $13,384,000. And that's because the actual assets, right, of the company, they're listed up here. Okay. They amount to 65 billion is all, when you count depreciation and all those things. And then you've got some liabilities, not really a bunch, but there's a little long-term debt, some capital leases, a few things like that, and we end up getting this equity figure of only 13,384,000. Okay, so that would answer the question. That would be fine. Amazon's price to book, meaning the market price, and that's one of these other figures that we could look at here. I've got to go back to just that quote, because they have the price to book right up here. Now, when I looked at it, was a little different, but now it says it's $21, right? Or 21. God, I keep saying dollars. It's just 21. And so what's that mean? Well, I had 20.2, meaning the market price per share is over 20 times higher than the book value, right? So Amazon's market price as of the close, and this 11.7 I put in there, divided by the 20.2 book value per share of 38.86 times 485 million shares equals 18,847,000. Now that's as of 9/30 of 16. The book value as of last year was 13,384,000. So when I was showing you that book value, going to the financials and looking at the balance sheet, that was at the end of last year. So it's actually jumped up quite a bit this year, and that's partly because their earnings have been quite a bit better than they have in the past. For Amazon, they've actually improved quite a bit. So that's why there's a discrepancy between this 19 million and this 13.4 million. Okay, And either way, either number that you might have put in there is going to be okay, just so you show a rational way of trying to calculate that and take a look at it. So why do investors think it's worth so much more money? The main reason is Amazon's just still rapidly growing. It's able to grow without having a lot of assets and stuff, as you might imagine if you look at the model of the company. Amazon has primarily been investing back into the company, any profits and whatnot, and so that's why their earnings per share are so low, because they're just taking every dime and putting it back into the company. At some point in time, they will start to monetize that, or they will start to show those profits. They'll saturate markets. They just won't have any place to invest those dollars anymore, and they'll start showing a bigger profit. At least that's what the investors think, and that's why they pay that much extra for it. So there you have assignment 3C.